Somewhere in Britain, this morning, a letter is landing on a doormat. It looks utterly ordinary. The lender's logo, a polite greeting, a reference number. But buried in the second paragraph is a single line that quietly announces a £6,000 a year pay cut. No manager delivered it. No performance review justified it. Your lender is simply informing you that your fixed-rate deal is ending. And the era of cheap bricks, that golden window where borrowing money was nearly free, has hit a hard, mathematical wall. For millions of households, the numbers are brutal in their simplicity. The legacy rate you locked in, that comfortable 1.5%, is expiring. The new 5-year fixed deal waiting for you averages 5%. On a £250,000 mortgage, that single shift adds an extra £480 every single month in pure interest. Not capital, not equity. Interest. Money that vanishes into the lender's ledger and never comes back. That's the notification. Now let's talk about why it feels less like a bill and more like the ground shifting beneath your feet. Rewind 5 years to 2021. Money was cheap, and we, quite reasonably, built our lives around it. A 1.5% mortgage didn't just make a house affordable, it silently shaped every decision underneath it. The car on finance, the kitchen extension, the school catchment area you stretched for, the holiday you booked without flinching. We didn't think of it as cheap money, we thought of it as normal. We baked a 1.5% interest rate into the very foundation of our lifestyle, the way you'd build a house, assuming the tide would never come in. And for a while, it didn't. The problem with baking something in is that you can't quietly take it back out again. The lifestyle stayed, the rate did not. Here's the clearest way to actually feel what's happening. Living with a 1.5% mortgage was like breathing at sea level. You never thought about the air. It was simply there, abundant, free, invisible. You could run up the stairs, carry the shopping, chase the children around the garden, and never once notice the mechanics of your own breathing. Moving to a 5% rate is like being teleported, overnight, to the summit of the Himalayas. Nothing about your body has changed. But the financial air is suddenly terrifyingly thin. Every ordinary movement now costs you. A grocery shop at Waitrose, a weekend trip to see family, a birthday dinner out. Each one demands twice as much oxygen, twice as much cash, just to get you back to standing still, hands on your knees, catching your breath. You are the same person, doing the same things, in the same home. But the atmosphere you're doing them in has been fundamentally, permanently altered. Let's name this rate jump for what it truly is. It is a private tax. It behaves exactly like a tax. It's compulsory. It's taken before you get to enjoy a single pound of your income, but it isn't paid to HMRC, and it doesn't fund a single hospital or a single road. It's paid straight to your bank, and it funds their profit margin. Now consider the scale. For a typical household, this jump lands with the same force as a 10% hike in your national insurance. Imagine the government announcing that tomorrow morning. The outrage would be deafening. It would dominate every front page. Yet this identical blow arrives silently in a polite letter, and we're expected to simply absorb it as the price of keeping a roof over our heads. There's a second way to feel the weight of it. In the old era, you were running the marathon of life in light clothing. You could feel the road, set your own pace, even enjoy the run. Then the bank handed you a 30-kilogram lead vest and told you to carry on. You can still run. That's the cruel part. You're not stopped. You're just weighed down. Every step now saps a little more of your financial vitality. Your legs burn on the school run, at the checkout, on the first of the month, and just as you start to adjust to the load, the bank leans in and reminds you that the race is only just beginning. Now, the lenders will offer you help, and this is exactly where you must be careful. The help arrives as an extended term. Instead of your mortgage finishing at 55 or 60, they'll offer to stretch it all the way out to age 75. On paper, it looks like a lifeline. The monthly friction drops, the direct debit shrinks, you can breathe again. 1 in 3 buyers are now reaching for precisely this: 35 or 40-year terms, chosen not because they want them, but because it's the only way to make the monthly number bearable. But understand what this really is. It is not a lifeline, it is a time siphon. Stretching the term doesn't reduce your debt, It dilutes it across more of your life and quietly hands the bank tens of thousands of extra pounds in interest along the way. You are borrowing freedom from your 70-year-old self to buy breathing room today. It steals your future to fund your present. You feel this most on any quiet morning, the exact moment the direct debit triggers. There's a particular sensation that arrives right then. You look at your professional salary, the one you worked years to earn, and you realize it isn't really landing in your account at all. It's just passing through. Your income has become a transit point, a station where money pauses briefly on its journey from your employer to the bank's profit margin. You are, in a very real sense, working the first part of every month for the lender and only the remainder for yourself. So how do you climb out of the thin air? The answer is altitude, and your altitude is set entirely by your LTV, your loan to value. Think of your equity as elevation. The more of your home you genuinely own, the higher you stand, and the thicker the financial air becomes. Rates don't slope down gently, they fall off cliffs at specific LTV bands. And the great oxygen line, the one that matters most, sits at 75% LTV. Break below that 75% mark, owning at least a quarter of your home outright, and you suddenly find pockets of oxygen. The sharper rates, the better deals, the products the bank quietly reserves for the borrowers it considers safe. Stay above it, and you're left breathing the thin, expensive air at altitude. Your entire renewal can hinge on which side of that single line you land. Here's where you seize back control. 2 levers. The first is the remortgage window. You do not have to wait, passive and helpless, for your deal to expire and dump you onto the standard variable rate, the SVR, which in 2026 sits somewhere between 7 and 8%. That SVR is the financial cliff edge. Falling onto it, even for a single month, is one of the most expensive mistakes a borrower can make. Instead, you have roughly a 6-month window before your current deal ends to lock in the next one, either a product transfer with your existing lender or a full remortgage to a new one. Start early, rates can be secured in advance, and a good broker will scan the whole market on your behalf. The second lever is lump sum pruning. Before your new deal begins, any overpayment you can make cuts straight into the balance, and crucially, it can nudge your LTV down across one of those cliff edges. A well-timed lump sum, dropped in right before renewal, can be the difference between an average rate and a genuinely excellent one. For homeowners in the home counties and far beyond, it's the single highest return move available right now. So here's the truth about a mortgage renewal in 2026. It is not paperwork, it is a resilience test. The cheap bricks era is over, and it isn't coming back on the old terms. But this isn't a sentence, it's a challenge with a clear finish line. Every pound of equity you build, every LTV cliff you drop below, every early move you make, thickens the air around you and lightens the vest on your back. Because true freedom in Britain isn't a low rate. It's reaching the altitude where your equity is high enough and your LTV low enough that the Bank of England no longer owns your heartbeat. That is the summit worth climbing for. And the climb starts the very moment that letter hits your doormat. If this video helped you, make sure to like and subscribe. I'll see you in the next one.